So, how do you even begin to organize one of the most chaotic, most fragmented markets in all of India? We're talking about pharmaceutical distribution. Today, we're going to break down Entero Healthcare's big bet, their gambit, really, to try and consolidate this whole thing. And the big question is it actually working?
All right, to get a sense of just how big we're talking, get a load of this number. Over 65,000. That's how many different individual pharma distributors there are in India. I mean, it's not just a big market, it's just completely shattered into tiny pieces. And this chart, wow, it really puts it all into perspective. Check this out. Over 90% of the entire market is run by these small, local, traditional distributors. The big national guys, they're barely even scratching the surface, you know? But for a company like Entero, that huge slice of the pie, that's not a problem. That's the entire opportunity right there for the taking. So here's the game plan for the next few minutes. We'll start with that fragmented landscape, then we'll dig into Entero's playbook itself. After that, we'll look at the numbers to see if it's paying off, peek under the hood of their acquisition engine, and finally, we'll talk about what's coming up next. Okay, so let's start with that landscape. You've got this sprawling, kind of chaotic ecosystem with tens of thousands of different businesses. Now, for most people, that just looks like a mess, right? But if your whole strategy is consolidation, well, that chaos, that's not a problem. It's the raw material for building something huge. And here's the real kicker. This massive market, it isn't just sitting there. It's growing, and growing fast. We're talking 10 to 11% every single year. So think about it. The prize for actually pulling off this consolidation just gets bigger and bigger with each passing year.
So the big question is, how is Entero actually planning to tackle this? Well, their whole playbook really comes down to a two-pronged strategy.
And here's how that growth engine works, step by step. First, they go out and buy up strong regional players. That's the inorganic part. But here's where it gets really smart. They don't just buy them and leave them alone. They plug them into this big national network. And then they use their tech and their scale to make those businesses grow even faster from the inside out. It's this brilliant cycle of buy, integrate, and then grow.
And hey, just so we're all on the same page with the lingo, inorganic just means buying up other companies. Organic means growing the businesses you already own. And this is where Entero sets a really high bar for themselves. Their goal is to make their existing operations grow at 1.5 to 2 times the speed of the entire industry. That's ambitious.
Okay, so the playbook sounds great on paper, but talk is cheap. Is any of this actually working? Let's dive into the numbers and check the scorecard. First up, let's talk profit, a 53% jump in EBITDA. And just as a reminder, that's a key way to measure how profitable the core business is. A jump like that year over year, that is a huge sign that this whole buy and improve strategy is really hitting the bottom line.
And that profit flows all the way down the line. We're talking about a 2.7 times growth in profit after tax. I mean, this shows it's not just about getting bigger for the sake of it. This is about smart, disciplined execution that's turning into actual real cash profit.
And wow, this chart right here tells the whole story. You don't need a finance degree for this one. Look at that swing, from a loss of 111 crore to a profit of 107 crore in just 1 year. That's not just a small change, that is a massive turnaround. It's probably the best proof you could ask for that their model is working. But it's really important to remember that behind all these impressive numbers, there's a real physical network on the ground. This isn't just some clever accounting. They're literally building a national distribution machine, one acquisition, one warehouse at a time. And here's what that machine actually looks like. I mean, just look at the scale of this operation. We're talking 79 warehouses covering 540 districts. They're serving over 86,000 pharmacies and 3,500 hospitals. And get this, they're juggling an inventory of almost 69,000 different items. That is the massive, complex, physical backbone that makes all those financial wins possible. All right, so let's zoom in on that inorganic growth part of the playbook, the acquisitions. How do they actually decide which businesses to buy? What's the philosophy driving that engine? Well, this quote from the CEO, Prabhat Agarwal, pretty much says it all. The key phrase here is margin accretive. In plain English, that means they refuse to buy any company that would drag down their overall profitability. Every single deal has to make them more profitable as a whole. It's an incredibly disciplined approach, and it's really the heart of their strategy. And here's what that actually looks like in practice.
The businesses they target already have pretty healthy profit margins, usually in that 6 to 8% range. Now, since that's higher than Entero's own average margin, every single time they buy one of these companies, it's like they're pulling their own average up. It's simple math, and it's super effective.
All right, so this strategy is clear. The results so far look really strong. But what's next? What does the road ahead look like? What are the big challenges and opportunities they're facing now?
Well, one of the first questions any sharp investor is going to ask about a fast-growing company like this, especially one that's buying up lots of other businesses, is what about the cash, right? I mean, you can look profitable on paper but still be bleeding cash, so what's the real story with their cash flow from operations?
And to their credit, the CEO addresses this one head on. He basically says, yep, it was a challenge. But he also says they've already turned a corner. They were actually cash flow positive in the second half of this year, and the promise is that for the entire next year, they will definitely be OCF positive. That's a big commitment. So where are they trying to get to? Well, they've put some clear targets out there. For next year, they're shooting for an EBITDA margin of over 4%. And in the medium term, so the next 3 to 5 years, they want to push that closer to 5%. Now, these aren't just random numbers. It's them signaling to the market, hey, we're confident our model can keep getting more and more efficient.
And all of this brings us back to that one final really big question. Entero has a super smart playbook. And the results? They speak for themselves. But let's be real. The Indian market is just incredibly complex, maybe one of the most complex in the world. So the ultimate test is still ahead. Can this acquisition-led model really, truly